$1 trillion. That's the number. Not a startup seed round, not a promising company that ran out of runway. The largest investment firm Canada ever built, the one that managed over $1 trillion across infrastructure, real estate, and private equity, walked out the door, officially transferred its headquarters from Toronto to New York. After 125 years, Brookfield Asset Management didn't fail. It didn't get acquired. It didn't collapse in a credit crisis or lose a legal battle. It chose to leave, on purpose, with a clean explanation. And Ottawa barely said a word. There's a reason that silence is worth examining. The man now running Ottawa, Canada's current Prime Minister, Mark Carney, was Brookfield's chair when that departure was announced. He didn't inherit this decision from a previous leadership team. He didn't discover it after the fact. He was sitting at the head of that table when the call was made. Hold that thread, because it becomes the most important part of this entire story. Here's what Brookfield actually is, not the name on the building, the function. This is the institution that put Canadian capital on the global map. For 125 years, it operated out of Bay Street and gave Toronto's financial sector its international credibility. The name that made foreign investors take Canada seriously. Brookfield actively deploys capital through power grids, pipelines, toll roads, data centers, and renewable energy projects spanning 5 continents. It manages money for the world's largest pension funds and sovereign wealth managers. When it was headquartered in Toronto, all of that activity had a Canadian address on it. The corporate tax flowed into Canadian coffers. The senior executive decisions were made on Bay Street. The institutional relationships that drive deal flow were anchored here. For 125 years, that is what made Toronto a name that mattered in global finance. Not the banks, not the real estate market, but the presence of a truly world-class institution doing genuinely global work. The announcement came just months before the move was finalized. That transfer is now complete. The reason given was clean and honest. Access to American stock indexes, specifically the S&P 500, and a broader institutional investor base. Translate that out of corporate language. The Canadian market isn't deep enough to hold us anymore. The S&P 500 is the most tracked equity index on Earth. Inclusion means trillions of dollars in passive investment flows automatically into your shares. Every pension fund with a global mandate, every sovereign wealth fund, every index tracking vehicle maintains baseline exposure to S&P 500 companies. Index funds buy every company in the index proportionally. You don't have to pitch them. They buy you because you're in. If you're not in, every dollar of that capital requires active outreach, competitive pitching, and ongoing justification. You are perpetually fighting for attention that S&P 500 companies receive automatically and at zero marginal cost. For a firm of Brookfield's scale, that passive access is not a nice-to-have. It is the structural difference between competing on a level playing field and competing with one hand tied behind your back. That's reason 1. Here's reason 2. A U.S. primary listing means daily trading volume. The TSX simply cannot match at Brookfield's scale. More volume means tighter spreads. Tighter spreads mean lower transaction costs for every investor who touches the stock. Illiquidity is a hidden tax, and every institutional allocator runs that number before they commit capital. A less liquid stock is effectively a discounted stock. At $1 trillion under management, that discount has a real dollar value attached to it. The TSX couldn't fix that. New York could. And reason 3, who you get compared to. In New York, Brookfield sits in the same analyst universe as Blackstone, KKR, and Apollo, the firms it actually competes with for global mandates and for senior talent. Wall Street covers them side by side. Institutional allocators evaluate them on the same screens, in the same due diligence process. A TSX primary listing puts you in a different comparison set entirely. Fewer analysts, narrower distribution, a smaller room. That's not a catastrophe on its own. But for a firm operating at the highest level of global alternative asset management, it is a ceiling. And it was a ceiling with a known exit. 3 reasons. 1 direction. And here's the part that matters politically. Mark Carney understood every word of that calculation. He had run the Bank of Canada. He had run the Bank of England. He spent his career at the center of global institutional finance. When he chaired Brookfield's departure decision, he was not a passive figurehead approving something he didn't fully grasp. He was one of the most financially sophisticated people on earth, running one of the most consequential investment firms Canada has ever produced. And the conclusion that firm reached, with Carney at the table, was New York. You cannot access the S&P 500 from a Toronto domicile. The TSX doesn't have that pull. For a firm competing for the mandates of the world's largest pension funds and sovereign wealth vehicles, leaving that capital off the table is not a sustainable position. So Brookfield made the rational decision. The rational decision was New York. And that's the most honest thing anyone in Canadian finance has said about Canada's competitive position in years. Not a scandal, not a collapse, a calculation. The math in New York is better. And when you follow that math, everything else in this story starts to make sense. Now zoom out, because Brookfield didn't happen in isolation. A decade-long study tracking nearly 3,000 high-potential Canadian startups found that of the most recently launched companies, just 32% were still headquartered in Canada. Not 32% of struggling companies, 32% of the best ones. 2 out of every 3 of Canada's most promising companies are now run from somewhere else. Not long ago, more than 2/3 stayed home. The collapse to 32% didn't happen gradually, it accelerated. Canadian AI companies recently raised $2.5 billion in a single year, and within months, new funding for the entire sector dropped below $1 billion. Y Combinator, the accelerator behind Airbnb and Stripe, confirmed it no longer invests in Canadian startups unless they first reincorporate outside Canada. The world's most important startup launchpad treats a Canadian address as a problem to fix before it writes a check. Canada's own startup visa program stopped accepting new applications after wait times stretched from 3 years to more than a decade. No serious founder waits 10 years for a maybe. They go to Texas, where a business can be incorporated in a week. The signal is the same from every direction. Canada is a place to come from, not a place to build in. Brookfield is what that pattern looks like after 125 years. Not a seed stage founder choosing Delaware over Ontario, a fully mature, globally recognized institution. And it still did the math. If the gravity of American capital markets is strong enough to pull a 125-year-old institution across the border, without a crisis, without pressure, without drama, the question isn't whether other firms will follow. The question is, what makes any of them stay? Right now, the honest answer is inertia. History, the cost and friction of moving. Those are not competitive advantages. They are countdown timers. That's how financial centers erode, not all at once. One rational decision at a time. Here's what this costs in practice. When a firm of Brookfield's size moves its headquarters and primary listing, the tax base follows. Corporate revenue, executive payroll, capital gains. All of it flows to a different government. The Canadian operations continue, but the financial center of gravity is somewhere else. And when it relocates for a company managing $1 trillion, the ripple moves through the entire ecosystem. The analysts, the fund administrators, the legal infrastructure, the institutional networks that orbit a firm at that scale. The crater is wider than the headline. All of that professional infrastructure begins to reorient around the new address, not next quarter, but over 5 years, over 10 years, over 20 years. Professional gravity follows institutional gravity. The support ecosystem clusters around the decision makers. And when the decision makers are in New York, the pipeline of talent and capital that flows into that ecosystem starts to reroute. That's how cities lose financial sectors, not with a single announcement, with 1,000 quiet decisions made by people who followed the firm. The quieter loss is harder to quantify. Canada's financial sector has long used Brookfield as the argument that Toronto is a serious global financial center, not just a real estate speculation market with a banking oligopoly attached to it, but a city with genuine world-class asset management. That argument just lost its best exhibit. When the next sovereign wealth fund asks why it should route capital through Toronto rather than New York, the institution that used to be the strongest answer is no longer in Toronto. The credibility of a financial center is built on the presence of institutions serious enough and global enough to anchor the argument. Toronto spent 125 years building that argument with Brookfield as its cornerstone. The cornerstone is now in Manhattan. What remains is still valuable, but the argument is harder to make. And in global finance, harder to make is another way of saying more expensive. Most Canadians don't own Brookfield units, but they live in a country committing billions to staying competitive in AI, clean energy, and infrastructure, all of it flowing through the financial systems and institutional ecosystems Brookfield just exited. Every dollar anchored in New York is a dollar not circulating in a Canadian pension, a Canadian infrastructure project, or a Canadian city's borrowing capacity. The address changes who the money works for. Consider what this means for the pension funds millions of Canadians depend on, the CPP, the Ontario Teachers, the OMERS. They manage trillions on behalf of teachers, nurses, and transit workers who are counting on Bay Street to fund their retirements. When the firms that anchor that ecosystem thin out, the cost of doing business in Canadian markets rises, steadily, invisibly, across decades. That cost eventually shows up in the retirement security of the generation that comes after. This is not a scandal. It is a logical conclusion. A country that assumed its best institutions would stay out of loyalty, out of history, out of inertia, and never built the market depth, the regulatory competitiveness, or the capital access to give them a financial reason to agree. The math has been pointing south for years. Brookfield just made the math official, and now the man who chaired that decision is standing at a podium in Ottawa, telling Canada it is time to fight back, time to defend this country's economic sovereignty. Mark Carney's argument may yet prove correct, but it is an argument being made by a person who, not long ago, presided over the single most consequential institutional vote of no confidence in Canadian capital markets in living memory. The failure was never the talent. The failure was never building the answer to a question that was always coming. What happens when the math in New York gets better than the math in Toronto? The answer isn't a press release or a sovereignty pledge. It's a capital market deep enough to hold what Canada builds. Until that market exists, the calculation Brookfield ran will keep producing the same result. The address will keep changing, and the trail will keep pointing south.